In this video, we're going to explore how agency and financial costs, how these all affect management's decisions. So first of all, agency costs, we've talked about these in previous videos. These are the costs that arise when there are conflicts of interest between the firm's stakeholders. In this case, we're talking about the difference between equity investors and creditors, right? Management generally makes decisions that increase firms' value. However, if a company has leverage, managers may make decisions that benefit the shareholders more and actually harm the creditors. And in the end, this could lower the total value of the firm. So let's think about this company. They're facing financial distress. They have a loan for $1 million that's due at the end of the year. Without some type of a change in strategy, the assets are only going to be worth $900,000 at that time. And of course, Baxter may default on its debt. So they're considering a strategy. The new strategy has no upfront investment, but it only has a 50% chance of success. If it succeeds, $1.3 million is the increase in value to the firm's assets. If the new strategy fails, the value of the assets are going to fall to $300,000. So a pretty big difference between values between success and failure. So the expected value of the firm's assets with this new strategy is $800,000. This is still a decline of $100,000 from the old strategy. So despite this negative expected payoff, right, some within the company might have suggested that they go ahead with this new strategy. All right, can shareholders benefit from this decision? Well, if it turns out to be successful, right, if they do nothing, they're definitely going to get nothing, right? If the strategy succeeds, equity holders get $300,000 after they pay off the debt. So given a 50-50% chance of success, equity holders actually have an expected payoff of $150,000. So even though it has a negative net present value, right, shareholders may want this because they have a potential to gain. And of course, debt holders are going to lose, right? So if the project succeeds, they get paid. But if it fails, they only get $300,000 out of the $1 million. So their expected payoff is $650,000, again, from the $800,000 that it was going to be worth. So that's $900,000, excuse me. It's a loss of $250,000 compared to the old strategy, right? 50% chance of $1 million, 50% chance of $300,000. So the expected value is $650,000. So the debt holders' $250,000 loss here corresponds to the $100,000 expected decline in firm value due to the risky strategy and the $150,000 gain. So effectively, what's happening here is when we're talking about taking some excessive risks, right, and asset substitution, right, the equity holders are essentially gambling with the debt holders' money. Because you remember, if they do nothing, they're going to get nothing. So they have to do something, and this risk-taking may provide them with this extra value. So this is what's sometimes referred to as the asset substitution problem. When we face financial distress, shareholders can gain at the expense of debt holders by taking a negative net present value project if it's sufficiently risky. So again, we have some in that, they have incentive to invest in negative projects that are risky, even though a negative net present value project destroys the value of the firm overall. So again, anticipate. Here's part of the deal: is do it's a question, I guess, that we don't have an answer for this, right? Is do security holders really anticipate this, right? Most investors don't have any idea of what's going on inside the company. So certainly managers have an idea of what's going on inside the company. But then the question is, will they tell anybody, right? Will that information bleed out to the public? Again, it's a question we really don't have an answer for. The next question is something called debt overhang and underinvestment. So assume that we do not pursue this risky strategy, but instead we're going to consider an investment opportunity. It's going to cost $100,000 and it will generate a risk-free return of 50%. So if the current risk-free rate is 5%, obviously this is a good project. It has a positive net present value. What if they don't have cash on hand to make the investment? Right? So how are they going to get this $100,000? They could raise $100,000 in new equity. If the equity holders contribute $100,000 for the project, they get back only $50,000. So the other $100,000 from the project goes to the debt holders, whose payoff increases again from $900,000 to $1 million. So the debt holders receive most of the benefit. And I think we're going to see in some later videos how this plays out with some easier numbers to absorb, if you will. But again, debt holders receive most of the benefit. So, this project is a negative net present value opportunity for equity holders, even though it offers positive net present value for the firm, right? It does increase value, but it doesn't increase value for the shareholders. So debt overhang, or the underinvestment problem we've been talking about here. Again, this is a situation in which equity holders choose not to invest in a positive net present value project because the firm's in financial distress. And the value of undertaking the investment is going to go to the bondholders rather than to the shareholders. And this is what they refer to as the debt overhang problem, right? When a company faces financial distress, it may choose not to finance new positive net present value projects. Cashing out is when a firm faces financial distress. Shareholders have an incentive to want to withdraw money. So it's likely, if it's likely the company is going to default, the company might sell off some assets below market value and use those funds to pay an immediate cash dividend. Again, this is another form of underinvestment, right? Because it's typically a negative investment, but the shareholders are going to receive the cash from this particular transaction. The value of the firm is absolutely hurt. Now, typically, companies would not do this unless they were in financial distress. So how do agency costs affect the value of leverage then? Again, leverage can encourage managers and shareholders to act in ways that reduce firm value, right? It appears equity holders benefit at the expense of debt holders. However, ultimately, right, in the end, these agency costs ultimately end up coming from the pockets of the shareholders of the firm. So when a company adds leverage to capital structure, the decision has two effects on share price. Share price benefits from equity holders' ability to exploit debt holders. Right? The debt holders recognize this possibility, right? And they pay less for the debt when it's issued, right? So debt holders lose more than shareholders gain in these kinds of activities. And the net effect is a reduction in the initial share price of the firm. So again, in the end, it's always the shareholders that pay. The direct effect, immediate effect, might be to the value of debt. But in the end, it also has an impact on the shareholder or the stock price. So the agency costs of debt are just another cost of increasing firms' leverage that's ultimately going to affect the optimal capital structure choice. So if you kind of think about that trade-off equation, right, those agency costs are part of the present value of the financial distress of a company. Because those costs, even though they may be indirect, and we don't know what they are exactly right now, they are real. So again, that's the end of this video, and we'll continue in the next video.